Hopefully we are starting. And are we live? We are live. Awesome. Oh my gosh, it has been a minute since I've done any of these live broadcasts. So quick disclaimer, if you hear my voice or you've at least heard me on videos before, my voice doesn't sound like this. 4th of July weekend was pretty great. So went to SeaWorld, rode some roller coasters, screamed my head off, lost my voice. So hopefully you guys can hear me. Hopefully I am coming through clear. If you're watching live, just drop it in the comment section. Let me know that you are hearing me. I'm coming in clear. And if you're watching this on a rewind, just go ahead and let me know where you're from, what you did this 4th of July weekend, if you did anything exciting other than get prepared for the storm that hit us. Outside of that, I want to share with you guys a quick tip as far as what's going on with mortgage rates, why I feel it's important, something that you should be following as far as a trend, especially if you're right in the middle of home shopping, in the sense that you've already began the application, you've already got an appraisal, but you just haven't locked your interest rate yet. This is probably going to be an important week all the way through the 10th. Even so, if you're refinancing as well too, and maybe you're shopping lenders based on that, this is going to be an important week, not necessarily because there's a lot of economic data that's out there this week. That's actually on the contrary, there's not that much economic data to move the needle. So a lot of buyers in the market and sellers, and what I'm referring to buyer and sellers in this instance has to do with mortgage bonds. How many investors are purchasing and selling mortgage-backed securities? If you don't know, I'll share this with you. Mortgage-backed securities are one of the major influences to interest rates. There's a whole bunch of other different factors that could move the market, if you will, just like any other market. But mortgage-backed securities is what we track next to anything else as far as knowing where the market's going to be as far as for interest rates. And so right now there's been a trend that's been going on. Actually, let me share this with you guys now. Hopefully you can see my screen. Good? Okay, good. There's been a trend since around the 17th, 16th of June. We kind of bottomed out, but then we've been going up, which when I say up, I don't mean the interest rates have been going up, just more so the price for the bond has gone up. And anytime you have bonds that are more expensive, they're higher in price, interest rates, note rates tend to be cheaper because there's so much more or less demand for it, if you will. On the flip side of it, when these start to become cheaper, bonds become cheaper, essentially interest rates are going to show higher. So this trend from the 16th, 17th has been a good trend. It's been favorable to us. A lot of us, if we're looking into locking, this is probably what you're going to be seeing anywhere from like 3.875, 3.75, depending on the program and the terms that you're doing, but it still had a 3 in front of it. That's essentially where I'm getting at. Now, as we go through the summer, I anticipate rates to continue to fluctuate and be more volatile, but this week in particular, you can see right over here, this green bar, hopefully you guys can see it right over here, that straight line at the top, where it forms the top of that triangle. Well, that's going to be a resistance area, if you will. And you can see back on the 10th, we retested it a couple times. And even back on the 24th, we retested it. We did pop up above it around the 6th, but for the most part, this has been a strong resistance for us to get out of that, at least post-COVID. And so as we're approaching that right now, this morning it was down here. But job reports data came out last week. It's been a long weekend, so a lot of investors, they finally digested that data. And so investors are back in the market, and we're having a stronger economy, but there's also a mixture report as far as unemployment rate. It went from 5.8 to 5.9. So when unemployment rates are usually higher, it shows a weaker economy, if you will. So usually when there's a weaker economy, rates are more favorable for that. The whole point to that is that there's two confusing reports that are out there right now, which is not really leading the market per se. Investors just are digesting that data and they're buying more into the market, which is essentially showing that we're having a spike up in pricing. Again, this is a good thing, not spike up in interest rates, spike up in pricing for the mortgage bond. Now, in some terminology, if you will, this could be known as a head fake. What I mean by that is I don't see this breaking this this top part, this top line, this resistance line right here. I think we're going to have a rejection. We're going to come back down. We may retest it again, but after the 10th, it could very well come all the way down to here. Hold on, let me make a line for that. It could retest here, and shoot all the way down. I mean, that's the furthest it's going to come down, is retest all the way down here to its previous low, at least all-time low, if you will. Or it can go to the upside, but we haven't had much traction for that outside of right up here. Make a line for that. And we haven't seen this area in almost 2 months. And we're going to be approaching 2 months here relatively soon. So there is a lot of room for upswing if we have that momentum, but do we have that momentum? And so that's kind of where I want your eyes to fall on the bottom graph. This is a stochastic, so essentially it's not telling you where the pricing is going, but more so tell you where the momentum is going. And so it's probably really hard to see this, but this little blue line above this red, that's a positive sign. Once it crosses this horizontal line, this green horizontal line, we enter into what's called an overbought situation. So this stock, this commodity, this trade, if you will, this is overbought by a bunch of investors, which usually turns into a correction, whether it be a small correction or a large correction. This is essentially what it's going to turn into. And so my prediction is that we're going to have a small correction. Do I see us coming all the way down here to its previous low when we had back on the, excuse me, let me take this off. Back on the 16th? No, we don't. Do I think we're going to retest somewhere around here? Let me make a line for that. Somewhere around this neighborhood? Absolutely. And once we come down to this area over here, you're probably going to have a 4 in front of your rate. If not, you're going to be still have a 3 in front of it, but you're going to have points, buy downs, things like that. And before I go into like points or anything like that, I don't want to stray off as far as the benefits of seller paid points. And this is not to dissuade you to not wanting to pay points, just to kind of give you the heads up that if you weren't prepared for additional costs, whether it's refinancing a home or purchasing a home, you might want to look into locking now. You know, have that conversation with them, identify what's the best possible option for you. When I look at pricing today, FHA and Fannie Mae, they all vary, but right now, from what I see, FHA is still leading the way as far as pricing scenarios. I can still get a 3 in front of my rates with minimal to no buy downs. And we're talking about scores that are 680 and above. You know, once you fall into 620 and below, you may still have a 3 in front of it, but you're going to have more points. You're probably going to be paying 1.5, maybe 2 points at most to acquire that rate. Conventional is more credit score driven. So remember this, folks. You know, if you're coming in with a 720 plus, I think that would be like the ground floor, if you will, for conventional, to where you get competitive pricing. It's not to say that you can't go lower than 720. Just once you get into the 680, 640 range for conventional, you get heavy loan level price adjustments. And so the rate won't necessarily be different, but the price for that rate will be astronomically different. So this is where you start to see heavy points. So the whole point to all this is this: whether you're going FHA, conventional, or even VA, lock down your rates. Let's not gamble with some of these scenarios. I like to advise a lot of, oops, wrong one. I like to advise a lot of home shoppers that if the rates get better, what are we talking about? Maybe an eighth, maybe a quarter at most, and we're only talking about a couple dollars here. Now, if it goes the other way, you know, it could be the same thing. Rates could be worse by an eighth or a quarter, or maybe the price for that rate could be worse. And so it's not something that I would professionally gamble or advise anybody to do. So outside of that, if you guys have any questions as far as where rates are at, what they're going to be doing, how it's going to translate to your financial scenario, I want you guys to make smart money moves. Regardless if you're working with myself or my team, at least you're going to be equipped and knowledgeable to know exactly when to be locking in for rates and when you should be shopping for it to get the best deal that's out there. Outside of that, I hope you guys have a safe week and stay dry out there. We do have a storm coming. I'm going to be doing another video like this on Friday, kind of elaborating what that storm means to you in relationship to home buying or even refinancing. Are there additional costs that are associated when there's a storm in the box, if you will? On that, I'll see you guys soon.